Well, hello, I'm Stephanie Flanders, head of Bloomberg Economics, and we're going to virtually cross the street now in Washington, at least institutionally, to talk to Dr. Carmen Reinhart, who was already one of the most influential economists in the world, even before her current job, through her research on government debt and the long-term implications of financial crises through history. But now she's in pole position as chief economist of the World Bank since last summer. Dr. Reinhart, Carmen, very good of you to join us at Bloomberg the year ahead. Let me get straight to the point of this year's recovery and what we're looking at. We've maybe a few weeks ago even, the world was quite optimistic about the kind of pace of growth we might see this year, a lot of demand pent up from last year. Now, around the world, concern around new variants, new question marks over the rollout of vaccines, great concerns about that process in the developing world. Are you looking fundamentally at a more somber picture when you look at 2021? Or do you think we could still see a decent recovery?
Well, I began to have my doubts about what was the prevalent view earlier in 2020 that this was going to be a V shape. Again, very different technology, very different world, but you go back to the Spanish influenza, and that kicked off in April of 1918, and circled the globe several times till 2020, 1920. So my expectations of recovery were always on the halting side. I think increasingly I am concerned that the damage that has already transpired will also be a headwind to a faster recovery. And unlike the 2008-2009 crisis, this one is really global. The 2008-2009 was really about a dozen of advanced economies that had bubbles in real estate and financial excesses. This is much more fundamental, much more broad-based. So I think I'm not looking for a quick recovery. And I think what my overarching message, this is with work that I did with Vincent Reinhart last summer for Foreign Affairs, don't confuse rebound with recovery. True recovery will take longer.
Well, I was very taken actually with the Global Economic Prospects report that came out from the bank this week did have a very somber tone, I thought, and the reference to many countries losing a decade or more of per capita income growth. And that's something that you have rightly focused on, what happens to income per head, not just the overall GDP. The divergence that we're seeing between developing and developed, there's a conversation around the K-shaped recovery that has taken the place of that V-shaped recovery. We talk about it in terms of inside economies, one group doing much better than the other. But do you fear that there's also going to be a global K-shaped recovery when you look at the prospects for developing countries versus advanced?
Well, indeed, one of the many concerning facts of this crisis is how unequal. It's a very regressive shock. It's regressive both within countries, both within countries in the sense that lower income households and smaller firms have taken on a disproportionate hit. It's also very unequal across countries, where the poorest and even considerably into the middle income haven't had the ammunition, the capacity to do the kind of counter-cyclical fiscal stimulus, the transfers for social safety nets, the spending on health that the advanced economies have done. And again, by contrast to the 2008-2009, after 2008-2009, what we saw, if you look, for example, at credit ratings, you saw the credit ratings of emerging markets go up while the credit ratings of the advanced economies went down. Now the wedge between the two is getting bigger, and it isn't because the advanced economies are being marked up. So it's very unequal impact globally as well.
And just in terms of how the international community can respond to that, I mean, you've pointed to, in past interviews, the lack of firepower, relatively speaking, that the World Bank and the IMF have to combat this inequality and this liquidity issues facing many developing countries. Of course, one thing that's been talked about as a response to that is an issue of new special drawing rights from the International Monetary Fund. I mean, is that something that you support, and is that something that you think is now more likely with this new Biden administration?
Starting from your last question, yes, I think it is more likely. Look, I think that the IMF, the World Bank, the multilateral banks have really, if you look at the volume and the reach of their lending in terms of number of countries, 2020 was an unprecedented year. So you try to lend as much as you can into an emergency like this. At the World Bank, within that lending, there's great focus on targeting social safety nets, precisely because of the issue that this is a very a crisis associated with increasing inequality. There's also been, of course, the initiative of the G20 to the DSSI, the debt suspension initiative, to allow countries to temporarily redirect funds that would have been used to repay debt, to redirect them towards emergency spending. But even with new lending, even with the temporary debt suspension initiative, you still at the end have countries that many of them were already frail, okay, prior to COVID. And those fragilities have really been increased because it really, if you look at many of the countries that are in most dire need right now, where we've seen per capita incomes fall more than 20%, like Angola, many of those countries were very much hit by 2015 by declining commodity prices, by the slowdown in China. So they were already in much weaker conditions, and there are indeed limits to what new lending and these temporary debt initiatives can do. I think what we're going to move to is, albeit I think slowly, is more debt reduction, more debt forgiveness. I think that's the next stage of the process.
So just to be clear, I mean, I want to get onto that, but you want to focus more on that. You think there's more traction to be got through that framework than through pushing on the SDR, or do you think you should do both?
No, they're not mutually exclusive. They are not mutually exclusive by any means. I think more firepower to the lending is more of a short run response. The more permanent reductions and restructurings of some of these countries that are in need, some of those debts, that's more a medium term. It's seldom achieved quickly, let me put it that way. Historically, debt restructuring takes time. We hope it takes much less time now than it did in the past, because that's the whole setup for lost decades and so on. But by no means am I suggesting that the two things are mutually exclusive. and would work well as complements.
Do you think that the SDR thing could happen in this year, in the next 12 months, or is that pushed off?
Look, certainly, so much hinges on the success of vaccines in terms of the potential for a recovery. I mean, you mentioned, we have our forecasts out there saying growth is about 4%. But look, if the dispersion around that is significant, you could see significantly higher growth if everything goes very smoothly in terms of global distribution of vaccines, or you could see less than half of that if the process is bogged down and doesn't quite have the speedy outreach that is hoped for. So in especially with renewed surges in infections and new variants of the virus, now another fresher source of concern, I could see the political willingness and international cooperation that could lead to moving in the direction of another allocation for this year. Yes, under these conditions, it's possible.
Well, that's certainly chastening for people to take on board that you think that the growth rate for this year that forecast could halve, given if we see a continuation of the kind of problems that we've had. On that common debt framework, I mean, clearly the key thing about that G20 agreement at the end of last year was the inclusion of China and others in the same framework, countries that were outside the so-called Paris Club. You've had Chad now be the first country to apply for restructuring under that framework. Are you expecting many more countries to join? And would that be a success to have, ironically, a success to see as many countries as possible use that framework rather than fight restructuring?
So, look, success is, when you're dealt with a bad hand, a quick response and quick correction is the preferred outcome, is not the outcome you would have chosen. You would have preferred not to be dealt a bad hand in the first place. But given that, as I said, a number of countries already started pre-COVID with very vulnerable external debt positions. So getting to the core of the question is Chad, a sign of things to come. Look, I am not looking for the kind of tidal wave that we saw in the early 1980s. Okay, and I'll explain briefly why. But we are looking for numerous, especially among some of the low income, highly indebted. Besides Chad, we have the case of Zambia. There's a question of, Ethiopia. There are many others that would benefit from a faster debt resolution through the common framework. But the reason I said I just want to go back to that I don't expect the tidal wave that we got in the early 80s is in the early 80s, we had a spike in US interest rates, where indebted countries saw their debt service skyrocket literally overnight. Here we have, given the low for long, we have an environment in which debt vulnerabilities are playing out at a slower pace, but they're still playing out.
Well, we have some questions in, and I just want to remind people that you can put your questions into the Q&A. One of them goes to something which has obviously been a big part of your academic work. It says, should governments maintain the same mindset towards spending and borrowing after the pandemic? Now, we've had, I would say, an officially a very relaxed position around government borrowing overall in response to the pandemic. And indeed, Kristalina Georgieva, who we just heard, whenever I've spoken to her, for someone who's the head of the International Monetary Fund, who's been very relaxed, very concerned about the risk of spending too little, not spending too much. Do you see a change in that mindset needed over the next few years, or do you think that that really is a very low-grade concern, the fiscal borrowing and levels of debt?
So look, let's not extend the horizon to the next few years. But certainly, I think the way, and I've reiterated these remarks in several contexts, I think the way many policymakers, I don't want to put words in Kristalina's mouth, but certainly also the way I view it is this is a war. It has the human cost, the cost to the economy, the cost to every development indicator almost that one can think about, has been, off the charts in terms of relative to any kind of business cycle or financial crisis you want to compare it to. So how do you react in a war? Well, you worry about winning the war, and then you worry how you're going to pay for the war. And one of the concerns that I laid out last summer in this piece that I mentioned with Vincent Reinhart is there is the risk that policymakers confuse rebound with recovery, which means you're really back to your pre-crisis per capita income, and tighten too quickly and declare victory prematurely. That scenario is a real source of concern. So, it's not that I embraced, high levels of debt. I don't take a benign view of having high levels of indebtedness, but I think the priorities is you first win the war. And we're still in the thick of it.
I know we're going to maybe, I hope, have time for two more questions, so I'll try and do it briefly. But it's been such a somber and appropriately somber interview. I wanted to try and tease out maybe a little circles of light. And one of them, if you look in the financial markets, obviously there's quite a lot of exuberance around the productivity improvements that could come from COVID, forcing companies to do things differently, forcing individuals to do things differently, changing supply chains, all of these things. Is there a part of that story that could also apply to developing countries? Is there any silver linings that you see or opportunities you could seize?
Look, crises, because they disrupt the very core of the economy and the way we work, the way we think, can lead. And I mentioned wars. By the way, wars have been, not exactly the way one would like to go about it, but wars have been period of a very intense technological innovation. And in this case, I think one of the fallouts that I'm on the positive side is also when you look at globally the amount of medical research that has been, brought to bear during the COVID pandemic. And one thinks of positive externalities that concentrated effort in medicine that we have seen in this crisis. I think we can't really measure what some of the benefits that may come from that. But, look, I think, one can say very little at this stage. I think there's still a margin of uncertainty on, what the new normal in terms of productivity, in terms of potential output is going to look like. And, I don't want to be a wet rag, but I think before we get to that silver lining, I think the emerging markets are going to have a very rough road. And we haven't even talked about some of the financial fragilities that I see evolving because the longer the slowdown, with new shutdowns, with tourism paralyzed, with trade not as bad as we feared, but still weak by almost any metric. Um, the effects of all of that on balance sheets of households and firms. Individuals who have lost jobs, firms that have shuttered and cannot reopen. The effects of that on bank balance sheets is yet to be felt because we talk about monetary stimulus, we talk about fiscal stimulus, but one big source of stimulus and liquidity during this crisis has also been that banks and financial institutions have adopted forbearance and grace periods for households and firms to repay their loans. We don't know what awaits us when many of those grace periods come to an end. Who will be insolvent and who will be illiquid? That's a risk still. So, we still have a rough road in the interim.